Hi everyone, it's Grant Abbott from Lightyear Docs and Abbott-Family here. I'm here with Michael, who's like a mini-me down below there, Mick. So
Hi, Grant.
how are you? I love accounting, so...
Good, thanks, Grant. How are you? I heard you had an amazing webinar yesterday.
Yeah, it was a great session. So if you haven't seen it, I blasted out. I was supposed to do 20 strategies in 30 minutes. It took 35 minutes, and the reason that was because Tim Munro came on and did 5 of his tax planning strategies. So if you haven't seen that session, it's an absolute smash out. It's a blowout. So if you just go onto the Lightyear Docs site, log in, obviously. If you're not registered, just register there. There's no cost. You can access all the strategy center. Some great information sitting in there. Go to the webinars and videos and have a look at today's Wednesday webinar video. And the point about that is that if you're not doing all these strategies like SMSF, testamentary trusts, in fact, you can actually do testamentary trusts for super death benefits that come from an industry or retail fund that bypass the estate, which means they don't get caught up in a family provisions claim. If you're not using living trusts, so you can get away not having to do wills and testamentary trusts, a whole range of great strategies were looked at. What I'd implore, and I've been telling all our top advisors, is that essentially if you really want to go down this space, work it hard, because it's a $7 trillion space of money's going from one generation to another over the next 15 years by way of property, shares, SMSFs, trusts, etc. Make sure you get into it. I give them the 2 key areas that they need to focus in on. First off is go to the Succession Asset Protection and Estate Planning Advisors Association. So the website's up and running now. So that's www.sapeppa.com.au. Register your interest. We've got over 150 people already have. If you're really interested, I've done some great work there in terms of building the actual standards, the compliance, and also the competency standards for advisors. We will be offering an accreditation soon, so it's an absolute must-have. So if you have a look at the estate planning piece, it's about 5% of the whole equation. So you're really working hard. The second one is make sure you get to the Master Strategy Day. If you haven't booked in, that is going to be an absolute cracker. We're going to be looking at 3 case studies, all the strategies you went through yesterday, but we're going to go and do a deep dive. So absolutely crucial for you to do that. That's on Friday, the 26th of March. And you get obviously the full recording, 7 CPD hours. So that's from my perspective. But look, Mike's been doing some great partner solutions strategies sessions. We've gone through quite a few, and they're always very entertaining and bringing some great people to the fore to help all of our advisors. So today we're going to have a look, and I'm personally very interested in this, having done through Abbott-Family more than $1.5 billion of property development advice over the last 5 years. The big issue is, where do we get our funding from? So it's going to be great to hear from Darren. So I might hand over to you, Mick. And Darren, I hope you don't mind that I'll probably butt in a few times and ask a couple of questions. But before I hand over to Mick, do you just want to give a bit of background on yourself personally, and also then a little bit about how Fundamental Business Finance started, where it's going, and what its mission statement is?
Sure. Thanks, guys. Thanks for the opportunity to have a chat on the Partner Solution Series. It's very exciting for me. I guess I've worked with Michael and Rod a little bit, more so Rod, coming across the risk side. And I guess Fundamental Business Finance is a bit of an unusual broking firm. We do specialise in what we call the 5 pillars of finance. We've currently got about 240 different lenders across those 5 pillars, which sounds insane, but you do sort of get to come across different, issues that our clients are trying to solve, and we're always looking for new lenders that are there to try and bridge that gap and unfortunately, a lot of lenders are coming out with new products all the time. So it sounds like a huge amount, but across the 5 different pillars, it's actually, you know, it's where we are and where we need to be. And we don't use all of them at the time. We may use 1 or 2 of those lenders once or twice that are just offering something quite unique for our client. So we've got all lenders across the major lenders, the second tier lenders, mortgage managers, low doc specialists as well. We seem to be doing a fair bit of low docs again, which is interesting. They weren't really the flavour of the month when NCCP came into the market, but personally, I think we're seeing an increase in them. We also deal with some self-managed super fund specialists as well. I guess that area has changed, as you'd probably be aware, over the last couple of years. It was predominantly residential. Now it's more moving over into that sort of commercial space where owner-occupier business owners are saying, why don't we buy the property that we're renting at the moment? We're seeing a lot of that.
Actually, I saw yesterday, Latrobe have got a product where if you've got a property that you're sitting on your balance sheet, whether it's in a family trust or whatever, you can release that up to 3 mil, obviously transfer it over in SMSF, limited recourse, obviously personal guarantees, and they'll do up to, depends on your credit rating, but up to a 70% LVR. So, you know, for anyone, it's a no-brainer because you're virtually releasing all that equity, putting it back into your business, and if it's a small business asset, an active asset, then effectively it's virtually tax-free. So it's just surprising that more people haven't done it. There might be some stamp duty costs. Over in South Australia, I don't understand why people don't do it, because over there, transfers of commercial property are effectively stamp duty free. So it's crazy stuff, but great strategies.
Yeah, definitely. And there has been a bit more appetite from the lender's point of view as well. We're seeing up to 80% as well. So yeah, definitely, if you know your clients are looking, or you have clients that are looking to do that, or you're looking to advise your clients to do that, that's definitely an area that we can help with. We also have a pretty large panel of trusted private lenders as well. And Grant, you talked about the development space. If you've ever played in that space, it can be a bit of a minefield. If you are using a private funder for the first time, we've had some horrific incidences ourselves, and we would never use them again. Unfortunately, it's not a nice journey in that space if you're having to learn the hard way. So we feel like we've got a pretty solid panel there now that we have, you know, trusted lenders. Some of them don't even advertise to the general market either. The last deal we settled just before Christmas, which was a pretty decent size 15 mil deal, was a 70% stretched LVR, commercial precinct development funding construction, which, yeah, is like, that's a pretty high LVR that is generally unattainable.
What was the interest rates on it?
Yeah, I was going to ask the same.
So the interest rate on that was, it depends if you're looking at it from just the rate as that's charged, or whether you're adding on, you know, the initial setup fee, and then, you know, because the generally a line fee, but it was around the 9%, including line fee, which is not too bad.
That's pretty good.
And then the setup
rate?
costs are generally, with this lender, was 1.5%, which is okay. And generally, as a broker, we charge 1%, which we know a lot of our competitors are charging 2% as well. So we tend to add in brokerage, lender setup fees, line fees, and the rate, and work out an overall percentage, you know, to work out cost factors. We do a lot of feasibility studies prior to lodgements for our clients as well, just to make sure projects are feasible. We have a good platform that we can use. So sometimes, and again, depending on the rate can vary depending upon the client's experience. You know, first-time developers don't get the rates that, you know, experienced developers that can show profit margins from, you know, 5 or 6 previous projects. So it's and in that instance, we generally recommend that some, you know, new developers engaging a good project manager. that will then offset that. So there's a few, the development space. I'm not really going to cover too much on that as one of the 5 pillars today, because it's a huge topic just by itself.
Absolutely. So it'd be nice to get you back into, because we've done a lot of work in that project development space of property development, and we've now got, obviously we do a lot in that SMSF at Abbott-Family, and the Commission's come out with a few rulings which have enhanced it, believe it or not. So that plug-in tool, the finance would be great. So we might have you on later on and do a property development session from woe to go, and work out the ins and outs of best financing versus the end play. I just have to ask, obviously the big question for me that I knew has come up this year. I just like to get your feedback on it. Obviously, the best interest duty for brokers, that had quite a significant impact on the financial planning community. How have you found it? Because obviously it's very, very new in the broking industry, so it's going to take a while for some of the old stalwarts to really get it out. But how are you finding it?
Did you want to give just a quick explanation of what it actually means first, Darren, and then go into what Grant? Because I think that'd be fantastic.
It's I will. It does still have a few grey areas that they're still sorting out the legal terms. Obviously, we have responsible lending, and now we also have best interest duty. And we've had a number of presentations from some of the solicitors saying they are directly in conflict of each other, or can be. So you can be saying 2 completely different things and meeting the obligation, the compliance obligations, but they don't even marry up. So it's quite interesting. So the best interest duty is obviously all related to the client, ensuring the client is getting what's best for them. To the point where if you only have a panel of, as a broker, if you only have a panel of 5 or 6 lenders, and there's better, products and services out there, better lenders, better products that you can't actually offer, the legal advice is that sometimes you have to say, sorry, I can't actually provide the best service for you. There's better out there, and you have to walk away from a deal. It's very driven for the protection of the customer, which most things are. It's added another layer of compliance onto already heavy NCCP and responsible lending, more paperwork. But as you guys are professionals already in your own industries, we all, I'm sure, do what's right for our client. Otherwise, we don't stay in business. I've talked about this to Michael when we met last week. It's the word of mouth these days. If you're not looking after your clients and not getting word of mouth referrals, then your business is not going to be growing. So again, I don't know what everybody else thinks, but I feel the government steps in and does too much sometimes for a lot of our industry and makes it a lot more difficult and sometimes more confusing for the client. But we try and keep that really streamlined. A lot of the work we're doing is in the background on the best interest duty. So it's really the compliance documents we're keeping on file if we are ever investigated and looked at, as to make sure we're doing the right thing. But I think the aggregators have been pretty strong in making sure they fully understand legally what's required and have implemented all the documentation that's required to make sure we're all doing the right thing legally.
Cool.
That's pretty much best interest duty. But yeah, I thought it was quite an interesting comment. I'm trying to remember the guy's name. I forget his name, but ex-ASIC and now currently advisor to the MFAA. Just explaining that the responsible lending guidelines and the best interest duty can still conflict each other. So and there's still some work to be done by the government, especially in what they call bundled deals. So I'll give you an example. If you're providing, let's say, a professional package with an annual fee, you get cheaper interest rates, you get some other financial benefits regarding account keeping fees, all those sort of things. but generally there is a credit card that's forced upon you. You must take it, and that's in direct conflict to the best interest duty. So they're definitely running around in the background currently trying to work out what the state of play is if anybody challenges that. So currently the government know that some of the things that we're doing right now don't actually meet the compliance regime, and there's obviously going to be a bit of a grey area or a grandfathering type period of time where these things are being sorted out. But yeah, I think there's a couple of things like that they're still tidying up, as the government always tends to do. They've implemented and now running around trying to make sure it actually makes sense.
It's probably the reason that the unions got rid of ME Bank, because that obviously it's pretty hard not to show that there's a conflict of interest when you're doing their super and offering them finance packages as well. So at least they got their money and run from that one. But look, I didn't want to bring it down, and let's get to the more exciting stuff.
No problem. We'll jump into presentation. If anyone has any questions, just make sure you put them on the chat to all panelists and attendees. I've just, Grant talked about it before, but I've dropped the link in for the SPEPA website in there. So jump on there and register some interest. I think Ashley said this morning we've had over 100 registered interest on the website alone since it's gone up in the last 24 hours, which is fantastic. So as Grant said, this is the Partner Solution Series. We've got fundamental business finance. Darren was just discussing it briefly then, but I've spent a lot of time, as has Rod from Eventum Optimum, trying to find the right finance provider or funding solution in terms of who we would want to partner with. We work closely with a number of different brokers, and probably one of my biggest frustrations is that a lot of the brokers are, I guess, one-man teams. They've got a para broker, for use of a better term, servicing them. What I liked about Darren was there was a number of things. Firstly, that they deal with all funding and finance solutions. So as Darren will go through them in a sec, those 5 pillars, usually you'll get a broker who tends to just play in the resi space or the commercial space, but not have access to all the various types of funding. And we, especially through, I guess, the asset protection business turnaround, we need to delve into a number of products with clients, which could range from resi to commercial to cash flow funding, debtor financing, and trade and motor vehicle and everything. And Darren can provide all that. And the big thing is that they've got a national footprint. They've got access to a large team across Australia. So files move quickly. They work really well. I've been working with Darren just in the last week or two on a number of clients. We bounce a couple of scenarios off, and they take them away, workshop them and workshop them with the client and myself and your clients, and to try and find the best solution and get a solution. So I just really like where we're going in terms of this partnership, and we're looking at bringing out effectively white label offering, which we can go into a bit more detail. Which will be great. So in that whole space. So we had a brief introduction about Darren before. I won't go any further through that. I'll just leave that slide. These slides will come out with the recording later today or tomorrow. They'll be up on the Lightyear Docs website, as Grant said. So Darren's given us an intro into fundamental business finance, and so I'll just jump in and let Darren give us which I'm really looking forward to, a market update across the 5 pillars of finance. I'm seeing it. I live on the Gold Coast, and I'm sure Grant is seeing it up on the Sunshine Coast, because I've been looking at doing a development with a client that Grant introduced me to up there. We actually missed out on it this week to none other than the Pratt family, who paid over what we thought. We did our I've got a client, a long-term client of mine, who did the property due diligence for me, and he's a first and second mortgage lender, and he got to a point where we thought we were at the market, and the Pratt family came in and outbid us by about $250,000 on a $2 million block of land. And so we sort of said, we're out. Our FISO doesn't stack up then. And he was surprised that they would have paid overs, but we weren't willing to pay overs. But just shows you how hot the market is out there. And I mean, the Gold Coast is going crazy. There's a house 2 doors down from me sold 2 weeks ago. The sign went up at 9 a.m. on Saturday morning. I walked down 15 minutes after that. And the agent was coming out and putting a sold sticker on and said that he had 40 people through, and it went within 10 minutes. So just
are they mainly people who are obviously just changing from different areas, or is it a sort of property where you can knock it down and then put up a couple of townhouses?
Yeah, no, the properties, they were actually relocating. I met them the other day, an elderly couple from New South Wales who were not really downsizing, but I guess they were from Sydney, sold their property down there for a couple of mil, came up and bought a 950 property that's a really nice house on the Gold Coast, and now living happily in retirement.
Yeah, it's a crazy. Well, we find that up at the Sunshine Coast is all the people have been sitting up the Sunshine Coast for such a long time. With the markets being dead, now it's hot, so they're actually all selling up and moving up to Hervey Bay.
Wow.
Yeah.
And so, I mean, I'll let you talk about that, Darren, but obviously, look, I put up a couple of themes there. Interest rates an all-time low, and they're expected to remain at that for some time. You know, house prices are rocketing, confidence is there. Everyone's talking about property, which can be a concern as well. There's supply and demand. The COVID impact, as Grant said, relocating. I know there's a lot of Melbourne and Sydneyites relocating to the Sunshine State because until now, Queensland's been quite insulated from what I call the vid. And people are relocating for that and other reasons. Population, I see, and I'll let you speak about it, Darren, but I was speaking to someone only yesterday about it. I think property prices will continue to have some pressure given that at the moment, we don't have any immigration because of COVID. So property prices are pushing up just on the domestic economy and on the lower interest rates. What happens when we open our borders again, when everyone has the vaccine and everyone wants to move? It's almost like the New South Wales and Melbourne people coming to Queensland. Everyone wants to come to this great island country of ours where we have been insulated from the virus. I'll leave it over to you now, Darren. And
yeah, sure. Oh, look, it's you're 100% correct with all those comments there. I think the CoreLogic guys came out 2 weeks ago saying they're estimating that the property price is going to jump between 15 and 20% over the next 2 years, and that was backed up a week later by the CBA economist as well. There were some figures thrown around that there's a direct correlation between the amount of lender applications that go through the system. They directly correlate to price increases, and as we're all aware, I think every broker and every lender has been having record finance loan lodgements for the last couple of months, and it doesn't really seem to be slowing down. So yeah, there's the word on the street is that you're correct that those prices are going to continue to rise, and the encouraging thing is they're talking, it's not just across the major capital cities with the vid, as you say. There has been a bit of a movement to move away from the capital cities as well. So they're predicting that the strong growth will be, in the country regions as well. So it's a full market wide prediction of growth everywhere. So very, very interesting, good times for everybody, especially if you're advising in property, if you're a financial planner advising in property, and those sort of markets. So I'll just run through. That's the start of my home loans. If you want to flick that next slide there, Michael. So basically, yes, record home loan applications off the back of the low interest rates and all the government grants that are out at the moment. Obviously, the first time grants are still around. The government re-released another issue of the first home buyer deposit scheme as well. So for those buyers, those first home buyers that are holding a 5% genuine savings, there's still some places available for the government to pay the lender mortgage insurance, which is pretty attractive. I think on a $500,000 purchase, it's an additional sort of $13,000, $14,000, $15,000 LMI saving, depending on which mortgage insurer that that lender uses. And then obviously the big kicker has been the two-stage federal government build grant, which comes to an end at the end of the month. But that $25,000 and now $15,000 additional grant has been one of the main drivers for the vacant land purchase, new construction. The whole construction industry has gone crazy. As I'm sure you're all aware.
Saw a lot of people accessing that, Darren.
Oh, definitely, yes. I'm not sure how many. Definitely on the new land and build side. Here in Queensland, it's. I have some financial planners that do property as well as referral partners, and they are under so much pressure from the developers to get finance organised quickly because there's a massive queue of people waiting behind them. There's just not lots available. If you can get one, you've got to be quick to get finance in. It's tough. North and south, hardly any blocks available. And speaking to colleagues in Sydney, same. So that's been a huge driver for the construction industry. The second part to that is the renovation side. If you're doing renovations above 150, you can also get access to it. But I've seen a couple, but I haven't seen as much demand for that as the new blocks and build. That's definitely been a huge driver. And I think that's been...
It's a decent... When I saw that come out, it's a decent renovation, over 150,000, isn't it? It's,
not a couple, with people lifting their homes and doing, full renovations, building underneath and extending at the back. It sort of worked well for those guys. But I think they were already there. They just fluked it and managed to get that, that 25K grant because they were pretty much ready to go and they hadn't signed the build contract yet. I'm not sure if it's really driving too much extra work.
Yeah, it wasn't there a cap on your income as well? So it was 150,000.
Yeah, there was I think it was 125 individually and 200. It was okay.
Yeah.
Combined.
It still was strange considering, I think it was 200 or something as you said, but 200, but you had to spend over for renovations. You had to spend over 150,000.
Yeah, correct.
So,
yeah. Yeah, and I guess that's probably why we haven't seen as much uptake on that one. So yeah, I've already covered off on the predictions for the property growth as well, and that's all across the city regions and country areas as well. So if you want to flick to, have a look what else we've got on here.
the 5 pillars up here. I think you're going through. So
yeah, so this is obviously the main. What most accountants would be seeing, if you've been working with brokers in the past, pretty much every broker does residential, and of course we do as well. It's part of our overall package that we do in the 5 pillars. All of our self-employed clients, which is mainly our core group of clients, obviously have a home and buy investment properties and do self-managed super. So this is still a key part of our business. So we're quite specialised in this. I look after this area a lot. In our 5 pillars, just to give you guys a bit of an understanding how we manage that, we do have an industry expert that pretty much oversees each pillar. For an example, we have Mark Taylor, who's ex-NAB, 25 years in asset finance, used to write product for NAB, used to train NAB, bankers nationally. He's a wealth of knowledge, and he heads up our asset finance team. Nathaniel looks after our commercial, in conjunction with one of our other partners, who's a CFO out of Adelaide. So he joined us about 4 or 5 years ago, and I guess this is where we saw our model working perfectly with accountants, CFOs, financial planners. Having that, complex understanding of corporate structures, et cetera, understanding financials, and then building our complex panel of lenders as well. As soon as Chris saw it, he was on board and said this model's amazing. So he still runs his CFO business. He looks after 3 of the largest industrial steel fabrication businesses out of Adelaide. And his business works perfectly well with the finance. He works with some of the key suppliers as well that he's built relationships through with those clients of his as well. So he's been, introduced to state managers, national managers, and then travelled to Germany to meet the actual family behind one of the largest crane suppliers to Australia. So he's now also looking after the asset finance side for those cranes that are, anywhere from 500 to 3 mil, which revenue-wise, he's doing a great job for the client, and for the supplier, and making some serious coin for himself as well. So look, the diversification piece, we love it, and being able to offer that to the business partners such as yourselves really gives you that extra income stream. It definitely makes your clients a lot stickier. And again, we're not just the residential home loan broker. We do understand and have key people running each department that have been in the industry for a long time.
Really, what resonated with me, as I was saying earlier too, I mean, it's, there's an expert in each of those 5 pillars that you can call upon, and workshop matters and issues through to get a solution. And then, they have been special experts in that space, and it really helps rather than, a jack of all trades or,
And our brokers come to us, some of them will know different areas, specialize in different areas, and then they're pretty much upskilling in each of the other pillars that they're unsure of. And we do a mentorship program, which I run. And it is a pretty steep learning curve, but the beautiful thing is it's our guys are all trained and understand about customer service and portfolio management, but the key part is we do have those heads there, and we do work well as a team. If we're not sure of something, we've always got a reference point to go to say, okay, I did this 2 months ago, what's changed, is anything new, who's the best at it now, is there anything that I need to refresh myself on? So because it is such a large scope of work that we're carrying as a broker, it's great to have an expert in each area that we can simply, those guys keep up to speed 100%, and we just tap into their knowledge base and refresh ourselves as we don't need to know everything ourselves. There's way too much to remember, but if we're able to tap into that knowledge base and then come back to our clients and our referral partners with solutions every time, then that's the model that we feel is working really well. Yeah.
Asset finance.
Just go back on that. I just saw the equity release there. I guess at the moment, I think I'm going to cover it off in the case study at the end. But we one of the points of difference I feel that fundamental business finance has compared to the banks. We obviously represent our client, your client, when it comes to negotiating finance. Unfortunately, a lot of the banks, and we've seen it, a lot of the good business bankers have moved away from the banks. Hopefully there's no bankers listening. But the broking space is becoming a lot more saturated with ex-bankers. The banks have the philosophy of, you get a home loan, work out that the client is also a business owner, then they'll try and do some asset finance. They'll try and make sure they've got a business account. The banker's job is to what they call grab full share of wallet. So they want to be doing everything for that client, and they have KPIs driven to make sure that they do meet those targets. We step in, and it's only grown this way through experience and coming across situations where a client's been referred to us by pre-insolvency specialist or an accountant that says, look, this is still a solid business, It just needs a good cash injection to get through this one-off event that's caused some drama. But that main financial institution who controls the business, basically, controls the decisions being made in that business, has total control over what decisions the business owner is actually making. Now, our strategy is, before you get to that point, you may have everything with your current lender, but they're not doing everything well. We know which lenders are doing what well. If you start doing some asset finance, let's say you're with Westpac and you start doing some asset finance with CBA, and you start doing some, some ATO debt consolidation with an unsecured cash flow lender, all of a sudden the lender starts asking the client, oh, why are you doing that over there? Why? They've been asleep for the last 2 years, 5 years, because they've already got full share wallet. They don't need to fight for anything. As soon as we trigger and they know that there's a broker involved, they're awake. They want to win back the business. They're battling hard to put lower rates in. So just us being involved with the client and the bankers, knowing that we're there, it just triggers a whole different mindset from the banker on actually looking after the client again. But we always say we're a multi-bank strategy provider, because we know that every bank can't provide the best in every area. They'll have one loss leading product. They'll get their clients in, and then they make their margins on all of the other products. Whereas when you're dealing with a broker such as Fundamental, we look, we search, we get our clients the best that's going in each of the 5 pillars that we work with, so that the cost savings and efficiencies within the business are down to the bottom line. So
I like to. My preference is to use multi as well, because they do try to ring fence you, obviously, and they like to have cross collateralization or money clauses, and become unstuck very easily with that. Yeah.
Oh, look, definitely. And of course, if they've tied everything up, which they can do, again, it's then we can write up a case that we can say, well, you already have plenty of security. You need to release this. The client wants to invest personally with their owner-occupied home. So it is a case. Sometimes we do that fee-for-service advisory where we're just doing some work for the client to actually just release securities, because we know that the bank holds too much. And if they won't, then if they don't do the right thing, then there's another option. You can just take it all away. Like they generally do the right thing eventually. But obviously, we have to make sure that everything stacks up as well, and that the equity's there, the business is still strong, etc., etc. But we're seeing, in this equity release one here, we do get those deals where the advisor's saying that this is still a strong business, just needs a cash injection. So we take it from that main financial institution who's not willing to help anymore, and we consolidate debts. And generally take out an equity release for the business to be able to operate and grow through the issue that they've had. And it's so rewarding. 12, 18 months later, you get your client saying, you helped save my business and my house. Love that sort of work. But it's something that I'm sure that a lot of the accountants do come across. Their clients complaining that the banks aren't helping them and just refusing to offer any assistance. So I think it's a pertinent one to discuss. Okay, if you want to flick over to the asset side, we do a lot of asset, and we do the easy asset, which the low doc asset finance with clients that have been in business for 2 years, GSU registered property owners buying from a dealer. It's the easiest finance we do. We love it. Right through to the complex, cash flow projection type credit memorandum lodgements for 3 mil, 4 mil, whatever, right top end of the market. So we cover everything. And look, I guess the important thing here, again, to work with the partners is to understand the client's business and the majority of our asset finance is chattel mortgage. It's generally a standard, but sometimes you do get situations where it may need to be a rental. So we always discuss those, once we come up with a solution. If it doesn't deem to be, that's the only place we go, we'll talk to a referring account partner and say, look, this is the only option for the client. Is this going to work with their business, etc., etc. Obviously, different claimabilities with rentals compared to chattel mortgages, etc. Yeah, I guess that communication is really strong with us, with our referring partners. Make sure we're all working in conjunction to make sure what's best for the client is achieved. Make sure that what they're the solution they're looking for is actually achieved as well. So I think that's pretty much it.
Business commercial finance.
Oh, we are seeing a bit of it's fairly busy at the moment, because obviously there's still the up to 150k 100% depreciation write-off in the first year as well. So plus, I don't know, I'm seeing lots of new company cars at the moment. There seems to be a massive wait with the dealers. I don't know whether anybody else is seeing that. I've got a number of clients waiting for 2-3 months for cars to get here. So very busy space. So the commercial business, we've got their commercial goodwill. So we've actually tied in the construction and development piece into here. We deem this so important that it's actually, we consider it to be our 5th pillar. But obviously with the JobKeeper coming to an end, we are obviously, I think lots of the accounting firms would be advising on the next move for their clients at the moment. I'm not sure, like, what are you seeing at the moment, Michael, in that space?
Yeah, it's. I mean, especially on the business turnaround pre-insolvency, we're seeing a ramp up this week. We've probably took, and it's been extremely quiet for the last 12 months, and that's we've been speaking to all others in the industry as well have been the same, because of the government stimulus and safe harbouring provisions and a number of other things. But we've had 5 or 6 very strong leads this week, which we're already strategizing, working through. Certainly starting to see a little bit of pain coming through, which was expected. So it'll be interesting to see how that rolls out. But we're expecting a very strong increase in that space.
Well, what I'm seeing is, and I know there was a bit of advice there around the tax positions and not paying tax, etc. So I'm definitely seeing a number of my clients that are needing to, or wanting to do some type of finance, but sitting on small to large ATO debt. So we're definitely seeing
the cash flow funding, cash flow and everything, because they effectively paid those amounts out, which left a lot of entities with debt positions because of the net GST position, rather than netting off the GST. And so it'll be interesting. And ATO have been, well, from my experience and speaking to a number of other accounts, have been extremely quiet during COVID in terms of debt collections. So I expect after 31 March, we're going to see a ramp up in that space as well. Because they must be sitting on a significant debt pile at the moment.
Which is massive area for us at the moment. And look, back in the day, before the short-term unsecured cash flow lenders were around, we would pick a Pepper or a Bluestone or a Liberty, and someone that's willing to pay out the ATO debt. If somebody was looking to release some equity, do a refinance, debt consolidate some business debts. The only issue, and it worked well, I mean, it was still good, but those lenders would be charging generally 1.5% to 2.5% higher than normal lenders. So it's actually much better now, where what we call like a 2-step process, where we look at that ATO debt, we bring in a unsecured cash flow lender to consolidate that, and then the new lender coming in on the home loan front doesn't see it as mismanagement in the business. They just see it as a business debt. So you can literally get approvals for home loan refinances and cash out facilities with the lower interest rates, subject only to the ATO debt being cleared. And then once that's there, it's a no-brainer. We then clear the ATO debt and borrow extra funds on the home loan to then clear the short-term funding, which is quite expensive. But if it's a $500,000 loan and you're talking 2%, that's 10 grand just in the first year by consolidating that. We don't like to do that. We would say it's better for you to pay anywhere between 3 and 5 grand to debt consolidate that ATO debt initially, and then set your home loan with the equity release up at a much lower rate from day one. And what we tend to do there in consultation with the accounting firms is to split the loan. So any business debt is always split. So you have your normal, owner-occupied NCCP debt in one loan, and then the second loan, which could be a combination of ATO debt, credit card business debt, any other business debts all gets pulled together. So then the client is still it still has trackable business debt, even though secured by the residential property. So again, it's still claimable. And I'm obviously it's not my area of expertise, but we do that in conjunction in discussions with our accounting partners. So that it's all, rather than lumping it all together and it gets lost, we do that split to keep the residential and the business debt totally separated for ease of accounting. What else have I got here? So the other side, the other one I just want to touch on there on the business one is obviously the government's got another the SMEG, we call it the SMEG loan, so the small medium enterprise government grant loans. The first release was a $500,000 loan. The interest rates were really low, but it was repaid P&I over 2 years. So those government loans were quite a strain on the cash flows because of the P&I repayments. The newest release is basically up to $1 million, but it's over a 5-year period. And I will just show you one of the recent settlements we've just achieved with ANZ using a combination of ANZ and the SMEG loan to achieve 100% purchase on a commercial property. So I'll run through that shortly in the case study. But yeah, as you said before, Michael, in that debtor finance space, in the small business space, the last 12 months just about non-existent for applications because there was the JobKeeper support there. There was a fair bit of cash around for the small business owners. We are starting to see that come back as more and more businesses release themselves from the JobKeeper.